Principles of Finance with Excel Modeling. Copyright Lou Gaddis. Topic 4, Discount Rates, CAPM and WACC. In this topic, we're going to understand the principles for choosing a discount rate for both NPV and IRR hurdle rates, estimate WACC, cost of debt, cost of equity, beta, and learn some new Excel skills. So in the last topics, we've been exploring NPV and IRR to decide whether or not to take on investments. And for NPV, you apply a discount rate. And if the NPV, the present value cash flows, is positive, you accept the project. And IRR, if the rate of return, the internal rate of return is greater than some hurdle rate, you accept the project. Well, let's talk about choosing those discount rates. The first principle I want to talk about is that discount rate that you use for either one of the methods should reflect the risk of the investment. So if you're looking at a project that is absolutely risk-free, that project should be discounted using the return that can be earned on another risk-free investment, say U.S. Treasuries. So say if your firm is looking at replacing some infrastructure and it's absolutely risk-free, I'm going to replace this machine with this machine and the cash flows are certain, that is a risk-free investment. And even if that firm is an extremely risky firm, you should discount that project at Treasury rates, because the alternative of a risk-free investment would be buying a Treasury bill for a short-term or a Treasury note or bonds for long-term. Now, if you're looking at a project that's risky, has uncertain cash flows, that should be discounted at a rate that reflects the risk of the project. And sometimes we'll call that the risk-adjusted discount rate, when a discount rate reflects the risk. Now on this topic, we're going to focus on one particular discount rate that's risk-adjusted, and that is the financing cost or cost of capital as a firm. Now when we talk about the cost of capital, it's a term we use a lot in finance, and what that is the rate required by debt and equity providers of the firm. Now it seems to make sense that the cost of capital should reflect the capital provider's assessment of the risk of the firm. So that is when someone buys a stock of a company or lends money to a company, it's going to assess the risk of that company. Therefore, what they demand, the return they demand, the cost of capital, should reflect that risk. And then intuitively, that if you're going to compute the NPV of a project for a firm or an IRR, you would think that maybe one candidate for the discount rate or IRR hurdle rate would be that cost of capital. And that way you ensure that the project will provide enough capital to pay off the financing. So that's the intuitive way of thinking about why cost of capital may be an appropriate discount rate for NPV and IRR projects. However, big caveat right here. The cost of capital is not appropriate for an investment if the project has significant different risk than the existing operations. So for example, we're going to talk about later, if Walmart is looking at launching another store in America, you could probably use the cost of capital for Walmart. In other words, look at current bond holders and lenders to Walmart and stock owners of Walmart and see what return they require, because I think that return is going to reflect the risk of Walmart's current operations. And then use that discount rate to evaluate whether you're going to open up that new store. However, if Walmart is looking at maybe changing their IT system, and that's considered maybe a risk-free investment, we know these cash flows are going to be known. In that case, Walmart will probably use a risk-free rate of return for valuing that project and calculating the NPV. So the same firm may use its own cost of capital to evaluate projects with similar risk as the firm, but may use the risk-free rate or a different rate for other projects. Now the candidate or the one measure of cost of capital that's most popular and most used is called the weighted average cost of capital. And we're going to talk a little more about the weighted average cost of capital. The weighted average cost of capital is a firm's cost of capital. Firms generally have two sources of capital providers. There's debt holders and equity holders. The funding cost from debt holders we call cost of debt, either represented as KD or RD for the cost of debt or the return on debt. Now, interest payments paid to bond and loan holders are tax deductible for the company. So what we'll generally use, or always use, is the after-tax cost of debt. Now bonds, we haven't really talked much about bonds yet. Bonds are loans made to corporations, and we're going to discuss those later, but at this point we'll just consider them loans. Now equity is another source of capital, so a firm may raise money by issuing bonds or getting bank loans, or it also can issue stock. The funding cost from the company's owners or stockholders is called cost of equity, either KE or RE. Now a stock represents a fractional share of ownership in a company. So if a company has 1 million shares and you own 1 share, you own 1% of the company. Now shareholders share in the profits of a company through dividend payments and the appreciation of the stock. And dividend payments are not tax deductible, so we don't have to take the after-tax cost of equity. Now here's the formula for the weighted average cost of capital. It makes a lot of sense. It's the cost of equity, whatever you believe the shareholders are demanding that the firm return, times the share of equity in total financing, so that's the value of equity over the value of equity plus debt, and making sure we use market values in this case. And then we have the cost of debt after tax times the percentage of debt in capital, so debt over equity plus total debt. So let's look at this simple example from the textbook. We'll copy this and we'll put it into Excel. And we have for United Transport, and we're going to calculate the WACC. So you've determined that your equity holders demand a 20% return for the risk in the firm, and bondholders require an 8% return. The corporate tax rate is 40%. There's 3 million shares outstanding. The market price of the stock is $10, and there's $10 million of debt. So now what we're going to do, we're going to first calculate the total value of equity in the firm, also called the market cap. So I'll take $10 per share times 3 million shares. That's $30 million in equity. Now one thing I want to mention is ideally we'd like the market value of debt and the market value of equity for every firm to calculate the weighted average cost of capital. And it's very easy to get the market value of equity just by taking the number of shares times shares outstanding. On the other hand, debt is very hard to figure out the market value of every bond and loan that a corporation has, and we just generally will use the book value of debt, and hopefully that's a good proxy for market value. So now we can get the total value of debt plus equity. So this firm has $40 million of capital, which is 75% equity and 25% debt. So 75% of the firm in some way is financed with debt, which requires 20% return, and 25% is financed with debt that requires 8% return. So let's calculate the weighted average cost of capital. I'm going to take my equity percent times my cost of equity plus my debt percent times my, and then take out taxes. So that's the after-tax cost of debt times the cost of debt. So I have my cost of equity times the weight of equity. I have my debt percent times my after-tax cost of debt. So in this case, the weighted average cost of capital for this firm is 16.2%. So if this firm wanted to launch another product in their business line, same risk as the firm, we can, using the same capital structure as the firm, we're going to use a 16.2% discount rate, either as the IRR hurdle rate or the NPV discount rate. We'll now compute the WACC of Walmart, which is a stock symbol WMT. So the first thing we're going to calculate is Walmart's cost of debt. Now there are several approaches for calculating the cost of debt. You could use the average yield on existing long-term bonds or loans. You can either look into the balance sheet or go on some of the financial services to see the bonds that are listed. You can also look up the credit agent or credit rating of the corporation's long-term debt, and then find for similarly rated firms what is the average cost of debt for firms with similar risk. And the last method is use the historical interest expense divided by the debt balance on the balance sheet. So let's look at Walmart. I went to Morningstar and I looked up Walmart, again symbol WMT, and what this is showing me is a credit rating, AA, which is also the S&P rating. The Standard & Poor's is a company that rates the credit worthiness of bonds. So they have the S&P company is rated that long-term bonds in Walmart have a rating of AA. Now we talk about bond ratings. Here's a little graphic here. The three big credit rating agencies, Moody's, S&P, and Fitch. They all have their different grades of bonds. AAA for all three of those is the top. Ds and triple Ds are the lowest bonds, are actually in default. So we consider these AAAs the highest rated bonds that exist. So these might be your top blue chip companies and government debt. In the investment grade, what they consider investment grade bonds, or bonds which they consider very credit worthy. You're more than likely going to get your money back, or very high likelihood of getting your money back. So you have for looking at the S&P ratings from AAA to AA to single A to triple B. Triple Bs are plus, triple Bs and triple B minuses. These are all considered investment grade. Now below this line, all three of the credit agencies define speculative or junk bonds. All right, now these bonds just have a relatively higher probability of default. So Walmart is a AA rated S&P on their long-term bonds. Then I looked up in finance.yahoo.com at their bonds and looked at composite bond rates. And I saw that long-term AA rated firms have a bond yield of 387. So what does this mean? Walmart has been assessed a AA credit rating. Finance.yahoo.com says that on average, AA rated firms have 387 yield on their loans, their bonds, for 20-year maturity. So that could be a candidate for using, or for the cost of debt. Now I can also look on Morningstar, and they list a bunch of Walmart's long-term bonds here. So I just looked at a bunch of their long-term bonds, took an average of a bunch of their long-term bonds, and it was about 376. So 376, 387, these are candidates for using cost of debt for Walmart. The advantage of using a composite is it's not subject to the the specific risks of these bonds, in which we don't really know a lot about these. Maybe it's a liquid or something like that. So you might want to just use 387. Now I also went to Walmart's income statement and balance sheet. Last year they had $2.5 billion of interest expense and $50 billion of debt, which is a 5% rate. I generally won't use this, even though historically you would think this might be very accurate to see what they actually paid. However, we don't know when these bonds are actually paid off. So these balances, I believe this is a year-end balance. We don't know the balance when those bonds actually came on. And also they might be very specific bonds. We don't know if these are short-term or long-term or had certain special provisions in them. So I generally will not use the interest expense from the balance sheet unless I can't find other data. I'm going to go with 387. Using judgment, the 376 is very close to 387. This appears to be an outlier, so I'm going to use 387 as the cost of debt for Walmart. All right, now I need cost of equity. All right, remember from our formula, I need cost of equity, cost of debt, and then the fractions of debt and equity and tax rates. So cost of debt, we're going to use 387. All right, the debt and equity percents, that's going to be relatively easy to get, and tax rates are relatively easy to get. So the big one is cost of equity. We're going to take some time to figure out how to get that. So when we talk about the cost of equity, all right, when we talk about equity, we talk about ownership. And when we talk about ownership, we're talking about the stockholders of the company. In calculating the expected cost of equity is pretty difficult. Now, historically, you can always see what the past cost of equity was, or the return on equity was. If I owned a share of stock last year in Walmart, I could take the price at the end of the year, we'll call it P1, minus the price at the beginning of the year, we'll call it P0. Add any dividend payment that was paid by the company, divide by the initial price. So what I have here is a capital gain, the increase in value of the stock, plus the dividend payment, the only cash payment the firm actually sent to the stockholder. And that could be a rate of return. So that would be a historical rate of return on equity for that particular period. The problem is, if I'm looking at the weighted average cost of capital and the cost of equity for Walmart to evaluate future projects, I need future cost of equity. And it's very hard to estimate this in the future. That's because dividends are uncertain. These are not contractual rates. Firms just declare dividends. In fact, many firms don't even pay dividends. Secondly, it's almost impossible to estimate what the future stock price is going to be. When we think about why does the stock price go up or down from, say, P0 to P1, the price at the end of some period, that could be a function of many different factors, such as what happened to profits. We call that the bottom line. If you think of an income statement, the bottom line is the profit line. Or maybe it wasn't driven so much by the bottom line, but maybe they had some revenue growth. So we call that the top line of the income statement. So maybe the firm's stock price has gone up, maybe because profits were even, but growth was going up. So top line growth made the stock price go up. Or maybe it's just an announcement of new strategy. Or some kind of a competitive environment. Target has a new ad campaign that seems to be stealing market share from Walmart, so the price goes down, which had nothing to do with Walmart. Or all the overall market sentiment. If the market crashes, it's going to bring down almost all stocks. So there's a lot of things that drive the future price of the stock, and dividends are uncertain. So you can't necessarily just look at historical returns of a stock or estimate the price of a stock and future dividends. What generally financial professionals use as a model to estimate what's the expected return of a stock in the future. That model is called CAPM, the Capital Asset Pricing Model. CAPM is a model that relates the risk of a stock to its return. So let's talk about this CAPM model, one of the most famous models in finance. CAPM model starts with a bunch of assumptions. And one of the main ones is that investors, those that buy stocks, are rationally diversified in many stocks. Therefore, the required return of any stockholder in a particular stock depends on a measure of risk. Sometimes risk, you can think of the term sensitivity of the stock relative to the entire market. So here, let me restate that. CAPM assumes that most investors don't own one stock, they own very many stocks. They're well diversified. Therefore, if you're looking at the risk of any individual stock, you have to consider the risk in the context of a big portfolio of stocks. Therefore, the risk measure is not necessarily just the standard deviation of a stock, but it's how it correlates to the overall market, because each investor basically holds the overall market portfolio. Now, this risk measure is called beta, which is a regression coefficient when you regress a stock's excess returns. That means, say, Walmart's return minus risk-free rate against the market's excess returns. Now, when we talk about the market over there, even though there's maybe 5 to 10,000 stocks in the U.S., we generally use the S&P 500 as a proxy as the overall market. So CAPM says that the measure of risk we should be concerned about is this risk called beta, which measures the sensitivity of an individual stock to the total market. How you measure that is you gather some historical data. Now this is a Bloomberg screen looking at Walmart last decade. And over this period of time, each one of these dots represents a particular return for a period. So this dot here, so on the y-axis here, it's the return of Walmart minus the risk-free rate. And this x-axis would be the return of the S&P 500. So this dot here says, now we look at the axis here, it looks like on that period of time, looks like Walmart's return was about 7% on that period. and the market return, if I look on this axis, was about 1%. So each one of these dots represents a particular X and Y coordinate of Walmart's return and the market. And then if I fit a line, a regression line, a best fit line through this data that best describes the relationship between the two factors, we call that a regression line. The slope of that line is the beta. So if I look at that, well, Walmart calls this a raw beta, is 0.76. Now the beta of the overall market by definition is 1. So if I take a regression of the S&P 500 versus the S&P 500, it'll lie along a straight line and have a slope of 1. So what this is saying, any company with a beta less than 1 has less than average market risk. Walmart's is 0.76. Now a more technical note, Bloomberg reports something called an adjusted beta. And this is based on a famous study, probably over 20 years now, that found that betas of companies tend to go towards 1 as they get older. So the idea is as firms mature, they look more and more like the market. And based on that study, they said that a good predictor of future betas for a company is take 2/3 of the regression beta, say 2/3 of 0.76, and 1/3 of 1. So basically all it does, it makes the betas go closer to 1. So here is the actual CAPM model. CAPM is a model that predicts the expected or required return of a stock. The formula says that any risky stock has to have at least a risk-free rate of return plus a compensation for risk. Now this compensation for risk has two components. It's the amount of risk, the measure of risk, which we're going to use beta, times the compensation for risk. We'll call that the market risk premium. So CAPM says every stock gets the risk-free rate of return. Otherwise, you wouldn't buy a risky stock. It didn't give you a riskless rate. Plus a compensation for risk, which is the amount of risk times the payment for risk. So to calculate this formula, we need the risk-free rate. Generally, we're going to use the 10-year Treasury bond yield. Now, some people will use short-term Treasury bill yields. But most professionals I've talked to will use a long-term Treasury rate. The idea that most investors in stocks are looking for long-term investments. So they're looking at, say, long-term bonds or stocks. Now beta, we're going to run that regression I just showed you by taking a regression of the stock's excess returns, the returns minus the risk-free rate, versus the market's excess returns. That'll be our measure for risk. And then lastly, we're going to multiply that times the market risk premium, which is the average return of the market versus the risk-free rate. Now, I looked at the risk-free rate as of the date of doing this analysis. 10-year treasuries are 170. The market risk premium, well, this market risk premium is the expected return of the total market, say the S&P 500, versus 10-year treasuries. So one way to look at it is I went to Oswald Damodaran's website. He's a famous researcher at NYU, does a lot of valuation research, and also publishes a lot of free data on his website. And one of these data sets is 1928 to 2015. Stocks returned 6%, a little over 6% over treasury bonds over that period of time. However, since 1966, it's only been closer to 4%. So these are candidates for your market risk premium, how much you expect the market to return over treasury bonds. Now, Oswald Damodaran also has a forward-looking measure of market risk premium called the implied market risk premium. And you can read about it on his site, and his forward-looking premium is also about 6%, close to that long-term average. Now, it's common to use market risk premiums of about 4 and 8%. We're going to use 6% for our analysis. So if I look at our CAPM formula, let's think about if we're doing the cost of equity for the whole U.S. market. I'd put the U.S. Treasury 1.7%. I said by definition, the beta of the market is 1. So if I take the risk-free rate times the beta of 1 for the overall market times a market risk premium of 6%, That implies that I expect the US market to have about a 7.7% expected return. But now we're going to apply this formula for Walmart by getting Walmart's beta. Now for beta, the common approach is to download some monthly prices and returns for the stock, the market, the S&P 500, and Treasury yields, and run a regression. So I'm going to go to Yahoo Finance, or finance.yahoo.com, get the Walmart symbol, look up their prices, get the S&P 500 index. Now the S&P 500, again, this is the Standard & Poor's company, has an index of 500 of the largest companies in the US. Now the symbol is a little hat sign, a little hat thing, GSPC in Yahoo Finance. I'm going to look that up to get the index of the S&P 500. And I'm going to look at Treasury yields. Now the symbol for the Treasury yields in Yahoo Finance is TNX with a little hat. And I'm going to download 5 years of monthly prices. So to do that, I would simply go to finance.yahoo.com. I start typing in Walmart, and you can see the symbol pops up, WMT. I can then click on historical data. And then I can ask for a period of time, say the last 5 years or so. I can ask for a monthly frequency. And I can ask for historical prices. I can apply that. And I could download the data. But I've already done that for you. So let's grab that data because I repeated that exercise for S&P 500, Walmart, and the 10-year. So let's grab this data. And I'll put it in sheet 2. So this spreadsheet has the S&P 500, Walmart, and 10-year Treasury percent. Now another technical note, when you download that data, you want to take the last column. So if I look at this data, and I opened up that table, I want to use the adjusted close. I can get rid of all of this data here. Let's talk a minute about the adjusted close. Now this is for Walmart, the adjusted close. Now if I looked at historically the prices of Walmart, these will actually not be the prices, even though this is an adjusted close price. And the difference between the actual price and the adjusted price is the adjusted close adjusts for stock splits and dividends. So in effect, what's happening is anytime Walmart would pay a dividend, the adjusted close will bump up by that amount. And if it pays a dividend, it would change all adjusted closing prices. And the reason it does that is if I take the percentage change of adjusted closes, that is the total return of the stock, including both capital gains and dividends. If I just took closing prices, that would just be the capital gain. So here's my data of adjusted closes. So let's get the total return, or the monthly returns of the S&P and Walmart. So in the S&P 500, this is May 2nd, 2016. I'll take the May price minus the April price divided by the April price. I'll copy that for Walmart, May price minus April. And now for the risk-free rate, this is a little different. This is an index of 10-year treasuries. So the 10-year treasury annualized yield is 1.75%. So I'm going to take that, divide by 100 to turn it into a percent, and divide by 12 to turn it into a monthly rate of return. So now I have the monthly yield of treasuries and the monthly returns of the market and Walmart. I'm going to copy those down, trim off that last row since I ran out of prices. And I said what I need to do is regress the market and Walmart's returns, again, or regress the excess returns of Walmart in the market. So I'm going to take the market minus Treasury, Walmart minus Treasury. So now I have the excess returns of both markets. Make sure I trim that last piece of data off. So now I have the data I want to run a regression against. Now let's think about this regression. Let me make a little more space here. Let me just look at the data first. I'm going to highlight this data. And let me insert a graph. I'm going to do a different type of graph. This is a XY scatter. So what this graph shows, the y-axis is the return of Walmart. The x-axis is the return of the market. Now I can try to fit a best fit regression line through this data. It's kind of hard to see what it's going to look like. It looks like it almost might be 0 if I think about what line best fits this data. But if I can click on one of these data points, do a right click, add trend line, and then ask for the formula, display equation. Let's try that again. I'm having trouble fitting everything on the space here. Well, looks like I can't hit OK, but here is the trend line. Oh, there it is. It worked. Here is our trend line, or the best fit line. And here's the equation they gave me. I'll try to make that a little bigger. Well, it looks like I can. But it looks like the equation is the y-axis. The y is the excess return of Walmart. The x is the excess return of the market. So the best fit equation is Walmart's return is 0.218 times the market's return plus a constant, which is pretty close to 0. So one way of thinking about that is if the market is up 10%, Walmart should be up 2% or 2.1% plus some constant. So this tells me that the market, or Walmart, seems to be safer than the overall market, less variable. So if the market is down 10% using this equation, Walmart would only be down 2%. So this is the idea behind a regression line. You take some y and x coordinates, fit a line that minimizes the differences, the square differences between that line and all those data points. And that coefficient between y and x, that's my slope of this line, but we also call that the beta. Now I could run a regression analysis. I like actually doing it graphically. I could do an insert or do a data analysis, run a regression where I put in my y variable, which is my Walmart returns, put in my x variable, which is my market returns. Now I'm going to leave the label there and click on label, and I could put the output right here, and here's my regression. There's my 0.218 coefficient to the market, and there's my r squared, what percentage of the variation in Walmart is explained by the market, and that's about 16%. So these are this is my measure of historical beta or regression beta. Now another way to do that without doing all this work is I can use Excel's slope or linest functions. Either one works. So you can either do equals linest, but I just like doing equals slope. It's the same thing. Equals slope. Put in my y variables, which is Walmart, comma, oops, put in my X variable, which is the market, excess returns, and there's, oh, looks like I gotta fix this a little bit. There's my 0.22 or 0.218, I believe, right? All right, that's another way of getting the slope. So you can either do an XY scatter graph and ask for an equation with a trend line, run a regression and get the coefficient, or use the slope or line est functions. Now 0.21, that says Walmart's has a very little risk. Again, zero would have Walmart would have zero risk and would only be expected to return treasury rates, right? Again, think about the equation. If Walmart, if I find my CAPM equation, if Walmart had a zero beta, it would only have to provide a risk-free rate of return. Walmart's beta is 0.2. So it would be 0.2 times the average return on the market over bonds plus treasuries. But let's use that to calculate the CAPM rate of return. So let's use a beta of the 0.21. And let's go ahead and do our CAPM formula. Risk-free rate plus beta times market risk premium. Looks like Walmart is going to provide a return of 3%. Now, to me, that just seems low. Walmart is a stock, even though it's a relatively safe stock, it is still a stock. And at some point, Kmart looked like a relatively safe stock until Walmart came to dominate it. So let's see. The only thing in CAPM that determines the rate of return that's related to a characteristic of the firm is the beta. So let's just see how beta has evolved over time with Walmart. So let me just use that slope function. Let's just see what beta was in just the year 2015. So I'm going to say equals slope. And let me just start here in December 2015 with Walmart. Grab 12 months. I'll hit F4 to anchor that, comma, grab the 12 months of the market. I'll anchor that. So in 2015, Walmart had a negative beta. That would imply that Walmart would provide a return less than treasuries. Well, I'm not going to take that deal. Let's try this slope again for 2014. I'm going to hit F2 to edit the equation. I'm going to slide this down a year. Well, let me try that again. Slide this one down. So in 2014, looks like I had a beta of 0.84. Let me copy that. 2013. Had a beta of 107. And 2012. Had a beta of negative 0.59. So we call this estimation risk. That we have this model that requires beta, and the long-term average is 0.218 using all the data, 5 years of data, but it's been as low as 0.6 and as high as 1.07. So I'm a little concerned about this model risk of estimating beta. Also, if you look at the beta, again, our R squared on that regression was only 16%, so it doesn't really explain a lot of the returns. So we're going to look at a different model for calculating beta. All right, so to talk about that, I need to give you a new equation. All right, we'll get to that in a minute, but let's do some terminology. When we talk about firms that are financed 100% with equity, in other words, they have no debt, no bonds, no loans, they're called unlevered firms. And where the term leverage comes is the idea that, like a seesaw or a lever, when you have debt, you've levered the profitability of your firm. Because when times are bad, you have these fixed expenses, which make times even worse. And when times are good, you don't have to share any of your profits. If you have lots of debt, you don't have to share any of your profits because you have fixed rates on your loans, so times are even better. So debt creates leverage for equity holders. Now, firms that have both equity and debt are called levered firms. In other words, they have some leverage. Now leverage again increases the risks of a firm. The increased debt is going to increase the risk of the firm, and good times are better, bad times are worse. Also, if there are higher tax rates, that's actually going to lower the risk of the firm, right? If a firm's half the profits are taken away and good times come around, the government takes more, the times aren't as good, but you get some tax breaks when times are bad. So if we think about the beta of a firm, we have a couple equations right here. Let's start with the one on the right. If a firm had no debt and we calculated the historical beta, that firm, we call it its unlevered beta, a firm's beta with no debt. Now, if the firm added debt, here's an equation that would tell you what would happen to the beta. The beta would increase because of the debt to equity ratio. So the equation is actually 1 plus the after-tax DDE ratio is equal to the levered beta. So the higher the DDE, the greater the levered beta, and the higher the tax rate, actually the lower the levered beta. And I could rearrange this formula and solve for the unlevered beta. That if you took Walmart's beta historically, now historically Walmart has had debts, we call that its levered beta, and divide by 1 plus the after-tax debt to equity ratio, that would be the beta of Walmart if they got rid of all their debt. Now, a common method for estimating beta that a lot of practitioners like to use because it's more stable, right, than this variation we've been dealing with, is to find an unlevered beta for the entire industry. So I can look up the industry beta where Walmart operates and consider that, and those numbers are relatively stable, at least relative to individual stocks. But then if I can find the unlevered beta of Walmart's industry, I can then lever it based on Walmart's specific tax rate and DDE ratio. So that's what we're going to do. So I went to Modern's website and looked up his betas by industry. And what I found is the unlevered beta adjusted for cash for retail general looks like is 0.92, and for food is 0.77. Now I looked up Walmart, roughly half of its sales are from groceries and half of its sales are just normal retail. So, and this is unlevered. So if we assume that Walmart just has the risk of the average industry in which it operates in two, I could just take half of the retail unlevered beta plus half of the food unlevered beta, and Walmart's industry, it's two industries would have a beta of 0.85. So I'll go ahead and put that in there. So half of 92 plus a half of 77. So half of 92 and half of 77. Oops, looks like something messed up there. 0.92. Says that Walmart should have a beta, if it had no debt, of 0.845 based on its industries. Now I'm going to use my equation that if I can get Walmart's market value DDE ratio and tax rate, I can estimate a levered beta for Walmart's industry risk measured by beta and its capital structure risk or leverage risk measured by DDE and tax. Now I looked up Walmart's market cap, 204 billion, and total debt of 50 billion. So I'll put that in, 204 billion and 50 billion. Their corporate tax rate was 30.3%. And I got that by just dividing the interest tax expense by divide the income before tax. And now I can calculate the DDE ratio. That would be D over E. And calculate Walmart's levered beta, which would be the unlevered beta times 1 plus the DDE after tax. So Walmart would have a beta of 0.99 I can plug that in my equation for CAPM, risk-free rate, plus beta times market risk premium. And that will give me a Walmart cost of equity of 765, which somehow feels better than this 3% based on this low measure of beta over the last couple of years, even though it's been much higher in the past. So I'm going to generally use industry betas. And for this exercise, we're going to use this Walmart industry beta levered up for Walmart's DDE and tax rate. All right. So now what I've done is I've taken an unlevered industry beta, levered up for Walmart's DDE and tax rate, and got a cost of equity of 765. We already estimated based on Walmart's AA credit rating. They have a cost of debt of 387. Based on the debt and equity ratios we just calculated, Walmart has 19% debt in financing and 80% equity, and we can calculate the WACC. So let's go ahead and use this format. I'm going to put my cost of debt, and that was 3.87%. I'm going to copy this formatting. We'll call this equity percent. Call this debt percent. Let's recalculate that. The percent of equity in Walmart would be my E divided by E plus D, 80%. And I'll just take 1 minus that. It's the easiest way to do it. Since this sums to 1, 1 minus 80% would be their debt percent. I can change those to calculations. And then I can calculate Walmart's WACC. Equity percent times my cost of equity plus my debt percent times my KD times 1 minus the tax rate. So now I get a Walmart WACC of 667. And that's how I would estimate Walmart's weighted average cost of capital. Here's the full equation. Here is your CAPM model, risk-free rate plus beta times market risk premium. However, beta, we took the unlevered industry beta times the 1 plus, that should be a U there, 1 plus the after-tax DDE ratio. That gave me my beta, plus my cost of debt times 1 minus the tax rate times my debt percent will give me my Walmart WACC. You could do some sensitivity analysis on your own time and see, based on cost of debts of say 3.25 to 447 and unlevered betas between say 0.24 and 105 or 104.5, I could estimate Walmart WACCs of between say 3% and 7.8%. So let's think about the big picture again. Why are we estimating WACC? Because we're calculating the cost of capital. And one candidate for the NPV and IRR discount rates is the cost of capital. So if Walmart is considering opening a second store in State College, Pennsylvania, that store probably has similar risk as the corporation in general. So we probably just use the WACC to estimate the NPV of opening another store. Now, if Walmart's going to open up another store in State College, however, it's now shifting its DDE structure, its DDE ratio. We call that the capital structure, the percentage of debt and equity and financing. So if they want to open up another store, but they want to finance it with different amounts of debt and equity and maybe a different tax rate, what I could do is I could use the same method as I did before, but then when I lever the beta, I can use the new D to E ratio based on the projected debt and equity percents and projected tax rate. That'll capture the risk of the new business, which has the same unlevered beta risk plus the new capital structure risk. And then presumably, maybe if the firm is going to use more debt and financing, you could estimate that, well, maybe this new Walmart might only have a single A rating and get a new KD. So this method allows you to have different capital structures. However, what this method so far is not good for, the way I've explained it, is what if they want to launch banks in every store? And what if that new venture, they're going to finance it using different capital structure? Now, what I would do in that case, I would not use Walmart's current WACC. What I would do is recompute WACC using a banking unlevered industry beta. So I go back to DeModern's website, find a retail banking industry unlevered beta, relever that beta for Walmart's expected DD ratio for their new banking venture, estimate what the cost of debt would be, what would be, say, the credit rating of that individual banking business standing alone, and calculate that as the WACC, use that as the NPV of the project or the hurdle rate IRR. Now, another little topic we want to do before we go away is learn a little more about VBA. Now, if you remember, this is from before, to calculate a function or to use a function in Excel or to create a user-defined function, we're going to go to back to Excel. I'm going to go to my Developer tab or hit Alt F11, Visual Basic. I'm going to insert a module. And to start a function, you write the word function. And we're going to create a function called WACC. Right. Notice when you hit enter, you get the word end function shows up. You got some space to put in parameters. So we're going to create a WACC where our parameters are KE, KD, corporate tax rate, E and D. So KD, KE, corporate tax rate, E and D. Those are called parameters or inputs. And the new thing I want to show you is before we actually type in the WACC formula here, we're going to create internal variables to the function. So let's call E% E divided by E plus D. So the equity percent is E divided by E plus D, and debt percent is equal to 1 minus E percent. And hopefully if I didn't spell it wrongly, I now have the equity percent and the D percent. So these are called internal variables. These are called parameters. Now I can calculate my WACC. WACC is going to be my E percent times KE plus my D percent times KD times 1 minus the tax rate. Now, I often make typos in this, so let's just make sure it works. Let me put in my function here. Click on Insert Function, User Defined. Look for WACC. I just type WA. I need my KD, my KE, tax rate, equity percent. Well, now this is just equity, 204, and debt, 50. And there's my 6.67%. So that's how you create a function using internal variables. And the advantage here, this is a lot easier to follow this program versus writing a longer formula here that incorporates the percentages. Again, I'll exit out. I don't have to save that, but when I save this file, I got to make sure, I'll just save it to a assignment. And I have to make sure I save it as a macro-enabled workbook, otherwise it'll delete the functions. So in this topic, we talked about the principles for choosing a discount rate. Those two principles are the discount rate should reflect the risk of the project, not necessarily the firm. And the second thing we talked about is the cost of capital is a likely candidate for NPV discount rates and IRR hurdle rates. And the WACC is the cost of capital for the firm, and it's legitimate to use that if we think that the risk of the new project has similar risk as the firm. And we learned some new VBA skills, creating internal variables.